Hello, I hope this finds you well. Today is Friday, May 20th, 2016, and in a few minutes I will share with you a brief overview of what happened in the markets last month in April, and I will also talk to you a bit about earnings. That is our theme for the day. But first, let me share with you what happened in the markets in April. The S&P 500, so the domestic stock market index, posted its second straight positive month of returns, posting a total return of 0.4%. Now, that may not sound like a lot, but if you remember what was going on in the markets in January and February, it's not too shabby. Back in February, on the 11th in particular, the S&P 500 was down almost 12% year to date. So with that perspective, we experienced quite a turnaround. So the question is, why such a turnaround? And we believe the answer is that investors are starting to breathe a sigh of relief as some of the big concerns that they were really focused on in the beginning of the year have started to subside. First of all, oil prices have started to increase. Secondly, the dollar is weakening. And lastly, there is less and less recession talk, certainly much less than we heard in the first quarter of this year. And those were three big themes that contributed to the sell-off in the beginning of the year. International stock market indices also posted positive returns. The MSCI EAFE index, which is developed international, and the MSCI emerging markets index, which is emerging markets, were up 3% and 0.6% respectively. Over in the bond market, the Barclays Aggregate Bond Index also increased slightly, up 0.4% on the month. So we saw lots of sectors of the market last month posting positive returns, albeit slightly positive. So for the remaining minute we have here together, I'd like to talk a little bit about earnings. The first quarter earnings season is coming to an end with about 88% of market cap having reported as of the end of last week. And while we may end up seeing negative earnings for the first quarter, there are some positives to glean from the reports in the first quarter. Despite a negative 6.3% EPS or earnings per share decline year over year for the S&P 500 index, if you remove energy from that, so X energy, growth actually looked a little bit better. Still down, but down 3.7%. As opposed to down 6.3%. Now, oil prices, as I mentioned, have started to show signs of stabilization and improvement, so we can reasonably expect that that sector could have a rebound in earnings by the third quarter or the fourth quarter of this year. So the two main drags so far on earnings this year as well as last year have been energy and the strong dollar. Both have been showing signs of improvement. Two factors that could also push earnings for the broader market into the positive by the end of the year. As always, thank you so much for taking the time to watch this. I hope it was valuable, and if you have any questions, please feel free to give me a call. Take care.